There's nothing better than getting paid every single month without having to lift a finger, and in my opinion, there's no easier way to generate this passive income than investing in dividend stocks. But not all stocks are made the same, so in this video, we'll be reviewing 10 of the most popular monthly paying dividend stocks, and we'll be ranking them from best to worst. And let me tell you guys, there are some pretty bad monthly payers out there, which you'll see as we go through it. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which monthly payers you have in your portfolio. I'd be curious to hear if you have any of the ones we're talking about in this video. But anyway, guys, when evaluating the rankings of these different stocks, we'll need a consistent set of metrics. And for the purposes of our video here, we'll look at 3 specific things, each of which will be given a maximum score of 3 points. Starting with the company's dividend yield. If the yield is below 4%, it will be given 1 point. If it's somewhere between 4 to 6%, it will get 2 points. And if the yield is above 6%, it'll get 3 points. Having said that, because we are assigning a higher score to companies with higher dividend yields, this might appear to glorify or favor high yields, which is something that I would normally advise against. However, in this instance, as you'll see throughout the video, these stocks that pay on a monthly basis tend to generate most of their returns through dividends rather than appreciation in share price. And realistically, you're buying these stocks primarily for the income. Therefore, in this scenario, a higher yield might actually be a factor worth considering. As always, though, it's important to remember that a high yield isn't everything. We want to make sure that high yield is sustainable. We want reliable income, which brings me to the second metric we'll be measuring, which is dividend growth history. If the growth history is less than 5 years, we'll give it 1 point. Between 5 and 10 years gets 2 points, and a dividend growth history above 10 years gets 3 points. But if the company has a history of reducing their dividends over time, which is the case for a couple of them, then they don't get any points in the dividend growth department. And then the last thing we'll look at is total return. How has the company stacked up against the S&P 500 over the last 10 years? If it's delivered negative returns, it gets no points. If the returns are positive but have considerably underperformed the S&P, it gets 1 point. If it's generated similar returns to the S&P, it'll get 2 points. And then if it's considerably outperformed the S&P, it'll get 3 points. Now, this obviously is not a perfect system, and this most definitely shouldn't be used as the basis for any real investment into these companies. But measuring and comparing these 3 things will at least tell us how much income each company is paying out to shareholders, how reliable that income is, and how each company has stacked up against the broader market over the last 10 years. And now getting into the stocks, you know we had to kick it off with the monthly dividend company, Realty Income, who has a 5.18% dividend yield, which is between 4 and 6%, obviously, so we'll assign it 2 points for that. And looking at the dividend growth history here on Seeking Alpha, they say that Realty Income's only been growing their dividend for 2 years, but this is not correct. Realty Income's actually a dividend aristocrat, and I think they've actually been growing their dividend for close to 30 years. It might be like 28 or 29 years now. Either way, their dividend growth history is consistently longer than 10 years, so we'll give them 3 points for that. And then looking at their total return against the S&P 500 over the last 10 years, we can see the S&P is up about 228% compared to Realty Income's 139%, which is not bad, but this is still considerably underperforming the S&P, so we'll give them only 1 point for that, bringing the total score for Realty Income to 6. And now moving on to the second company, this is Main Street Capital Corporation, another very popular monthly payer, and they have a 6.5% dividend yield, so we'll give them 3 points for that. If we look at the dividend growth history, technically they've only been growing it for 2 consecutive years, but they've been making payments for 11 straight years with a lot of consistent growth in that time period. If we look at the dividend history chart, it looks like they paused the growth between 2020 and 2021, but otherwise the growth here has been very consistent, guys, going all the way back to about 2014, 2013 it looks like. And with that, guys, I might be bending the rules a little bit. You'll have to let me know what you think in the comments, but I still think Main Street Capital Corporation deserves at least 2 points for this. I know their dividend growth history is not technically above 10 years, but this is still pretty impressive growth, so I'm gonna go ahead and give them 2 points for that. And then looking at their total returns against the S&P, it says similar returns here, which if we look at the chart, we can see they're pretty neck and neck. In fact, Main Street Capital Corporation on a total return basis has outperformed the S&P over the last 10 years with a near 236% return compared to the S&P's 228%. Now, although they've technically outperformed the S&P, I don't think this is really a considerable amount, so we're going to go ahead and give Main Street Capital Corporation a 2 in the total return department, which brings their total score to 7. So this is the top dog as of now, but we're only 2 stocks in. This third stock is AGNC, another very popular monthly pair because they have a really high dividend yield. look at that, guys, double digits, about 14.5%. So we're going to go ahead and give them 3 points for their high yield. But the dividend growth history and their track record of growing this dividend is terrible. 0 years, and they've actually been reducing this dividend over time. As we can see, over the last 5 years, the dividend has gone from 18 cents per share per month all the way down to where it's at now, 12 cents. So because of this, we're not going to give them any points for their dividend growth history. And now looking at the total return, they have dramatically underperformed the S&P 500. Over the last 10 years, they've generated just under a 50% return. So it is positive, but still dramatically underperforming the S&P. So we're only going to give them 1 point for that, which brings AGNC's total score to a 4. And then next up, guys, we are looking at PSEC, who also has a really high double-digit yield at 11.4%. So we'll give them 3 points for that. But just like with AGNC, the dividend growth history is terrible. 0 years of growth, and they've also been reducing the dividend over time. In 2014, they were paying 11 cents per share per month, and then they cut it down to where it's at now in 2017, 6 cents per share. So in this time period, the dividend has been reduced by about half, so that's not great. And because of this, we won't be giving them any points in the dividend growth department, and they've also been dramatically underperforming the S&P. In the last 10 years, you would have seen an 85% return with PSEC, which is not bad. This is still positive, but is nothing in comparison to the S&P's 228%. So we'll give them a 1 in the total return department, so that brings them to a total score of 4, just like AGNC. And then, guys, this brings us to the fifth stock of the day. This is Agree Realty Corporation, who has a 4.4% yield. So between 4 and 6% there, we're going to give them 2 for the yield. And then as far as the dividend growth history goes, Seeking Alpha has them at 0 years of growth and 0 years of payments. But if we scroll down looking at the dividend history, this is also not true. Up until the end of 2020, they were paying quarterly payments, and then they switched to monthly dividend payments right here, which is why Seeking Alpha cut their dividend growth history to 0. But if we switch views and look at the annual dividends paid over the years, we can see this number going up every single year, at least for the last 10 years. So this could go back even farther, but ADC has at least a 10-year dividend growth streak. So we'll give them 2 points for that. And then on a total return basis, they have actually considerably outperformed the S&P. And looking at the chart over the last 10 years, with ADC, you would have generated a 263% return, which is almost 40% above the S&P 500. So I think that's pretty substantial. So in the total return department, we'll give them a 3, which brings ADC's total score right up there with Main Street Capital Corporation, sitting at a 7. And then moving on to stock number 6, this is Gladstone Commercial Corporation with a really high dividend yield, 8.9%. So we'll give them 3 points for that. But they have 0 years of dividend growth, and they actually just cut their dividend, as we can see right here. They cut it earlier this year from 13 cents on down to 10 cents. So we will give them no points in the dividend growth department, and they have dramatically underperformed the S&P over the last 10 years with a 63% return compared to the S&P's 228. So we'll only give them 1 point for that, which brings Good's total score to 4. Anyway, guys, stock number 7 is Orchid Island Capital, who has the highest dividend yield of the day, coming in at just under 19%. So we'll give them 3 points for the high yield, but the dividend growth history is atrocious. 0 years of growth, and they've actually been reducing this over time. If we look at the dividend history chart, you guys can see this is like one of the most unreliable dividends you've ever seen. It does nothing but go down over time. That's definitely not what we want to see. So we will not be giving them any points in the dividend growth department. And then looking at their total return against the S&P, it's pretty weak, guys. I mean, ORC's generated about 10% the returns over the last 10 years that you would have gotten with VU. It's basically 24% versus 228%. So we'll only be giving them a 1 in the total return department, which brings ORC's total score to a measly 4. Anyway, next up, guys, is Stag Industrial, a very popular monthly paying REIT who has a 4.1% yield. So we'll give them 2 points for that. And the dividend growth history is pretty solid. 10 consecutive years of dividend growth. So we'll give them another 2 points for that. And then the total return is actually looking pretty good. They are neck and neck with the S&P 500, 217% across the last 10 years versus the S&P's near 228%. So about a 10% difference between these two. So we will give them another 2 points for that, bringing Stag's total score to 6. And then, guys, the second to last stock of the day is Apple Hospitality REIT, who has a 6.4% yield. So we will be giving them 3 points for that. And they technically have 0 years of dividend growth, but as we can see from this dividend history chart right here, they are starting to build this back up. And it looks like they've made a couple raises to the dividend just in the last year or so. And I want to give them some credit for that. So we'll be giving them 1 point, but they still have dramatically underperformed the market. And if we look at the chart, it's kind of a similar situation as to what we were seeing with ORC. They were generating about 10% the returns of the S&P 500 over the last 10 years. So because of that, we'll only give them a 1 in the total return department, and this brings their total score to 5. And then the last stock of the day, guys, is SL Green Realty Corporation, who has a really high yield sitting just under 9%. So we're going to go ahead and give them 3 points for that. But the dividend growth history is actually kind of interesting. If we look at the growth chart over the last decade, there's been some very consistent dividend growth growth, but unfortunately they just cut the dividend. Just cut it recently. Looks like they cut it in about half here, so we can't give them any points for their dividend growth. And then if we look at the total return across the last 10 years, this one is pretty atrocious. Out of all the stocks we talked about today, this is the only one with a negative return in the last decade, minus 33%. So definitely underperforming the S&P 500. So we can't give them any points for their total return either, which brings SLG's total score to a measly 3, the weakest of the day. And then now that we've gone through all 10 stocks, guys, this spreadsheet here has them categorized from highest score all the way down to lowest score. And as we can see, the top 5 here are going to be Main Street Capital Corporation with a 7, ADC, Agree Realty Corporation, also with a 7, Realty Income with a 6, not too bad, Stag also has a 6, and then in 5th place here we have Apple Hospitality REIT, which I think was carried by its high dividend yield. Otherwise, things weren't looking too good in the dividend growth department or the total return department. And then these bottom 5 guys, all of these right here have scores of 4 and below, and the one common thing we can see with all of them is a lack of dividend growth history. In fact, if I remember correctly, all of these have reduced their dividends, so that's not great, and that's definitely not what you want to see. But all 5 of these also had really high dividend yields. But like I said earlier, yield is not everything. You got to look at the whole picture. You got to look at the yield with the sustainability of that yield, and also how much returns you're generating overall. So with that said, all 5 of these bottom stocks here, in fact, I even might include Apple into this one. These are all ones that I would stay away from. And with that, I've actually got 5 more stocks in this next video right over here that are along the same lines and are ones that you should never buy again. I would definitely consider all 5 of these to be yield traps, and they're ones that you should avoid at all costs. So click right over here to find out why, and I'll see you in the next one.